Okay, good afternoon, everyone. Thank you for joining us. A big Happy New Year to all our clients and prospects and introducers and everyone on today's webinar. Hope the year started well for you all. And for those on social media, a big hello. We'll be filming our webinar across social media live as well. Today's webinar is the first of our end of year series. So the first 3 months of the new year is very tax and financial focused. We want to ensure we're giving lots of opportunities to communicate with everyone in order for them to be efficient, save money, and of course, save tax. So today's webinar, it will probably last around 30 minutes to 40 minutes. We'll be allowing for questions towards the end. You'll note on the right hand side that there is a chat function. So if you do have any comments or questions throughout today's webinar, then by all means, please put them through on the chat facility, and we will most likely come to them towards the end of today's webinar. For those who are watching on social media, if you do have any questions, please feel free to put them in the comments section, and I will go through them at the end of today's webinar. So just to go through today's agenda, we're going to quite a jam-packed session. We're going to cover quite a lot. I'm going to basically talk over initially the tax sort of changes to coming in 2024 and some planning points of what you should look at, in particular capital gains tax, inheritance tax. We're going over briefly some compliance points because obviously we are in January with only sort of 2 weeks towards the tax return deadline. So of course, I'm going to go through a few bits to make you aware of for the tax return. I'll then hand over to my colleague Chenji, who will talk to you about some pension contributions, ISAs, and some other financial planning pointers. And then finally, we'll revert back to me where I'll cover over tax planning, intergenerational tax planning, and then we'll conclude today with a Q&A for any of the questions that you have. So today's webinar is brought to you by our company, which is the Fusion Consulting Group. I'm representing our Fusion Tax Department, and my colleague Chenji heads up our Financial Advisory Division. You'll be able to see our contact details on screen. So of course, when we're talking about your personal circumstances, be it tax or financial planning, you may not want to ask questions in a format like this. So feel free to email us any specific questions you have, or indeed, if you want to arrange a consultation, then we can do that as well. Not a problem at all. Just to say, the idea and ethos behind the Fusion Consulting Group is that we provide a 360-degree service for you, your family, and your business, having all your key advisors in the one company, advising you across everything to ensure that you're achieving things quicker, be it tax, financial planning, law, or accounting. And there's a nice diagram to illustrate that. Okay, so we'll just come on to my first few slides. So we're talking about capital gains tax. So of course, the year end is coming up towards the end of March, beginning of April. And we've seen that the capital gains tax allowances have been reduced. So they were reduced this year to £6,000. And from the 6th of April 2024, they're going to be cut down further. Of course, in between all of this, we do have another budget coming up, I believe on the 6th of March. So we'll see what comes out on that one. But for now, capital gains tax is going to be reduced in terms of the allowances. You do have that opportunity prior to April to make use of your capital gains tax allowance, because these allowances are essentially a use it or lose it basis. You can't, unlike some other allowances, carry forward to another year. So particularly if you're thinking about selling an asset, then it'd be mindful to look at what that will mean from a capital gains tax perspective. Do you want to benefit this side of the year to take advantage of another £3,000 of tax relief, or are you going to push that sell into the following year? Of course, if you own assets jointly between spouses or civil partners, then essentially you have two lots of allowances there to benefit from. So in terms of capital gains tax planning, we mentioned gifting. So it might not just be a sale of an asset. You may want to consider gifting. So we get asked these questions a lot in terms of our planning, our intergenerational family planning. If you gift an asset to someone, then that is also considered like a sale. So if you want to gift a rental property to your child, then essentially that transaction would be treated as what the market value is at the date of the gift, less the original sale purchase price of that property. And then from that, there'd be capital gains tax to pay. But of course, you'll have your annual exemption. So again, if you're thinking about gifting property or any other assets, you may want to think about the capital gains tax planning points this side of the tax year, in order to benefit from that increased allowance before that gets decreased into the current tax year. Gifting between spouses, civil partners, there is no capital gains tax. So you may want to consider, as part of your planning, if you do are in a relationship, to potentially get married to benefit from that tax exemption. But no, I'm not really going to be on here and give marriage advice. But that's always good from a sort of tax planning perspective, looking at, can you gift an asset from a tax perspective to a spouse or civil partner. Some of the elements around this could be if you are a higher rate taxpayer and you're receiving a certain type of income from an asset, and then your partner is a lower tax basic rate payer, you may want to consider the opportunities about gifting that asset, part of the asset, whatever it may be, to your partner or husband or wife, so you could benefit from their basic rate band, and of course no capital gains tax between partners. Just to say on that, if you own an asset jointly, so if you own a property in joint names, and essentially you're a high rate payer and your partner is a lower rate payer, then you can fill in a certain Form 17 to HMRC. So even though you own the asset 50-50, if you wanted to declare the income on a different percentage split, you can do that from tax perspective reasons. That would need to be accompanied by a deed of trust, but essentially, if you own the asset jointly, you're allowed to do that. So that may be something you may wish to consider heading into the new tax year as well. So just a brief cap on the inheritance tax amount. So you're allowed essentially to gift £3,000 each year. And unlike the capital gains tax allowances, this essentially, if you didn't use it in the prior year, it can be added to this year. So essentially you have a £6,000 annual exempt amount that you can gift each year, with £3,000 each year, £6,000 if you haven't the previous year, without there being a direct charge to inheritance tax. And of course, that will essentially sit outside the estate, surviving the 7 years. We've just put on this slide a tapered down percentage rate in terms of, we all are aware of the 7-year gifting rule. That's essentially if you gift something to someone from an inheritance tax point of view, if you survive 7 years from the date of the gift, then we know that sits outside the estate from inheritance tax. If you die within those 7 years, on the screen you can see the percentage amount of what that will be in terms of tax on the gift. So 3 to 4 years, 32%, 4 to 5, 24%, 5 to 6, 16%, 6 to 7, 8%, 7 or more, 0% inheritance tax. I think just the point on inheritance tax is that it can't be looked at in isolation. If we're looking at a gifting of an asset, then as I mentioned in the prior slide, then you need to consider the capital gains tax position, and then of course the inheritance tax and potentially stamp duty. So this is just to summarize the point about gifting. Just to mention trusts at this point, there's no capital gains tax on a gift to a trust. So if you are considering protecting the asset, protecting the bloodline, then trust work might be useful to consider. Anything above the nil rate band, which is £325,000, there is a direct tax charge of an asset going into trust. And then of course, once an asset is into trust, it's protected within your family bloodline, but again, you need to understand the income tax positions on that. There's also what's called a 10-yearly tax charge once an asset is into trust as well. So you know, when it comes to tax and gifting and moving of assets, you just need to know the full impact across all the different taxes to make a good decision. So moving on, so we're now coming on to the dividends. So dividend allowance. So again, this has been reduced from £2,000 to £1,000, and then as of the April 2024, it's going to a mere £500. Again, that could possibly change on the 6th of March, but for now, again, looking at the dividend distribution, can you declare a dividend? Have you taken that right amount out? Can you take that tax-free amount out, and then essentially benefiting from that now? And then obviously next year that's getting reduced. Again, this is a use it or lose it allowance. It can't be carried forward. So make sure if you are a director or shareholder of a small company, you do have reserves that you haven't taken. Depending on your overall income strategy, you may want to take that £1,000 as a tax-free amount there. And then, of course, as a company director, you need to be continually monitoring what the most efficient way is to extract monies from the limited company. Traditionally, it used to be a small salary and the rest is dividends. But now, with the dividend allowance being reduced, with dividends being taxed at the various tax brackets, essentially it may not always make sense just to pay a small salary and the rest is dividends. What we're finding now is that there's a mix of paying a decent salary and then some dividends, and then along with financial strategies and corporate strategies aligned with that. Let's see. Moving on to the corporation tax and changes as of 23 and 24. So as we know, from the 1st of April 2023, corporation tax rose to 25% on companies where their profits exceeding £250,000. For profits which were less than £50,000, there was a small profit rate of 19%. And then for companies between the profits between 50,000 and 250,000, there was essentially a hybrid amount to pay. From obviously April 2024, that 25% rate will continue. So again, it's about understanding what can be done as a company director in order to pay less tax, see what reliefs are available to you, see what restructuring needs to be done across an overarching strategy. So, there's no major point in terms of planning, I guess, from this tax year in terms of changes. I guess it's just about being as efficient as you can be in terms of looking at things about how you can utilize. Do you have a company pension? Are you putting through the relevant life insurance? Have you considered all additional tax reliefs that are relevant to you? Are you in the right structure? Do you have capital allowances? Are you doing any offshore work? So, just going through everything in a mini RAG report to ensure that you're doing everything you can be. And again, as of the 6th of March, this could possibly change. So the final slide for me, just on this first part, is just on the tax return. So a lot of people will be filing their self-assessment tax return by the deadline, which is 31st of January 2024. That is for the tax period April 23 to April 24. And I just put on the notes a few things that you may want to consider, which people might make an error. So the first is, if you or your partner receive child benefit and any of you earn £50,000 or more, then the child benefit will need to be documented on the tax return and then tax paid back of what you've received on that child benefit. In terms of the rental property, any rent from rental property, along with the necessary expenditure, will need to be documented. In terms of the expenditure, just be careful to understand the difference in what you can claim between what's allowable and not allowable, particularly if you have capital items of expenditure, such as a new kitchen, a new bathroom, building work in terms of an extension. That would all be classified as capital of nature, and that would be essentially used when you sell the property. Any capital gain, so if you've sold an asset, of course, that would need to be documented. There's been a lot of attention around if you're operating a side hustle. So that is any additional income in excess of £1,000 if you're trading. So that could be if you're buying and selling clothes, if you have an online business, money from social media, whatever that additional monies may be, and it's classified as trading, then that should be documented on there. Income less expenses. And finally, any cryptocurrency income or gains should be documented as well. So that's just not just exchanging as a crypto asset to cash. That is exchanging, it could be a crypto gain between one coin to another coin, one asset to another asset. So all this information would need to be documented on the self-assessment tax return itself. Of course, if anyone needs help with anything, we can assist here at Fusion. I'm now going to pass you over to Chenji, who will talk you through the next few slides.
Hi everyone, thank you, Mitch, for a great overview of all the taxation aspects of the end of tax year planning. So what Fusion Financial does, we work closely, me and my team work closely with Mitch and his team in terms of implementing a lot of their tax advice strategies. So we actually do a lot on the product side, right? How certain tax saving strategies actually come into fruition. So today, we're going to mention a couple of last minute sort of calculations before the end of tax year, simple planning opportunities from the financial side where everybody can take advantage of to reduce the tax bill and set themselves up for a very tax efficient new tax year and moving forward. So we're going to mention a bit about pension funding, how you can maximize your wealth creation using pre-tax cash. And that applies to both people who are employed and those who are directors and owners of their own companies. We are going to talk a little bit about the ISA allowance. It is on a user or losers basis, and just some tips and tricks about capital gains tax planning, how to use the exemptions in the best way via financial products, and also about tax loss harvesting as well. And in the end, also just going to mention a couple of pretty cool investments that you can do to save some tax and just to give everyone a good overview of them. So first of all, pension contributions, quick recap. Again, your pension, if you are an employed person, you will receive full income tax relief at the marginal rate. What does that mean? It means if you're an additional rate taxpayer, which, if you earn over £125,000, you will get, for every pound of money that you put into your pension, you do get 45% tax relief. If you're a high rate taxpayer, you get 40% tax relief. If you are a basic rate taxpayer, you get 20% tax relief. And actually, if you are 0%, if you're a non-taxpayer, you still get 20% tax relief up to your UK relevant income, which is pretty cool considering you haven't paid any tax, but you are actually getting some tax relief in your pension. If you are a director of a limited company, you are able to get corporation tax relief on any money that's paid into your own pension by your business. So if your business has got £10,000, for example, and you would have paid £2,500, which is 25% in corporation tax, if you put that £10,000 into your pension, you would actually save yourself that £2,500 corporation tax bill. In addition to that, now that's the tax relief going into your pension. Your pension is actually outside of your estate, which means it's fully protected from inheritance tax. So any money that's in your pension, there is no 40% inheritance tax due. Also, any assets that's actually invested, so that's gains that be it interest payments within, from the cash assets or bonds, be it dividend distributions, be it capital gains that you made, from inside your pension, everything is free of tax. So all the growth, all the income inside your pension during the lifetime is tax-free. Now, one thing to be careful is that it's quite easy to over-contribute, especially for high earners. Now, the standard pension allowance, annual allowance for the current tax year and the following tax year is £60,000, which may be subject to change depending on a different government potentially. You are able to also claim carry forward contributions. Now, for high earners, and that applies to people who earn over £260,000 of income, you will actually have what's called a tapered allowance, which means that for every £2 you earn above that threshold, your annual allowance gets reduced by £1, right? And it does apply to a lot of actually like doctors as well, right? So, where you have, where again, for those high earning doctors and who have NHS contributions, pension contributions being paid in by the employer, it's quite easy to actually go over that allowance, especially if it's tapered. So please do speak to a professional advisor, be it tax or financial, just to check that you are compliant in terms of this. Now, you can also contribute to other people's pensions. So you don't just have to contribute to your own pension. And that includes your spouse and your kids. And like I mentioned before, even people who don't pay tax, i.e. children, for example, right, who have no income, or, potentially spouses or adult children who have little to no income and non-tax paying, you can still receive up to £3,600 per annum into their pension. That gets them tax relief. Moving on to the ISA allowance, as I mentioned before, you do get £20,000 each tax year to be put into an ISA, which is use it or lose it. It doesn't get carried forward, unlike your pension allowances. Now, similar to your pension, everything within your ISA grows tax-free, right? So interest payment, tax-free. Capital gains, tax-free. Dividend distributions, tax-free. And what's really good for the ISAs actually over the past year has been that now that the additional rate tax pen has been reduced to 125,000, whereas before it was 150, a lot of people actually have found themselves, having £0 of interest allowance. So as long as you earn over £125,000, every pound of interest that you make, you actually have to declare that in a self-assessment and pay the government 45p of that interest. Right? Now, bearing in mind, you saved that money after having already paid income tax, and now you have to pay another income tax on the interest that you get. By putting that money into a cash ISA, you will receive that income or the interest income from the cash fully tax-free. So you saved yourself 45%, which is, again, very smart planning to make. Now, you can transfer ISAs funds, across the different types. So if you have a cash ISA, you can transfer it to a stocks and shares ISA and still retain your allowance. Which means you can still contribute up to £20,000 per year. And similarly, you can transfer stocks and shares ISAs into a cash ISA. And again, the appropriateness of how you want to transfer ISAs across, please speak to a professional advisor. Happy to help. And again, as always, we offer a no obligation initial consultation. Now, currently, until April 2024, you can only contribute to one ISA of each type. Now, in the recent budget in November, the government actually changed this rule. So starting in the new tax year, you are now able to contribute to more than one ISA of each type. So if you've contributed already to one, for example, a cash ISA here, right, with say HSBC, you are right now in the current tax year, you can't just open up another cash ISA with say Halifax and then put more money in. But in the new tax year, you are able to do that. So they are helping you be more flexible with ISA planning. In addition, for children, right, so those under 18, even though they don't have a full £20,000 ISA allowance, they do have what's called the junior ISA allowance, which is up to £9,000 per tax year. And again, same as the ISA, everything inside grows tax-free. Now, just a really quick slide really on time in the market versus time in the market. And this is, quite important thing I always tell, our clients, which is, why be bothered with the pension? Why be bothered with an ISA, right? Because inflation erodes the real value of your money over time. And if we look at over the last 2 years, and that's the slide on the left, right? Now, the red line indicates the actual inflation. So that's the consumer price index. It's grown by 14% over the last 2 years. And you can see over the last 2 years, actually, right? Now, the blue line indicates how cash has actually performed. So if you saved your money in a 90-day notice account, you would have gotten only 4% over the last 2 years, which isn't a lot. And you're definitely way below the inflation rate. And if you put your money into what's called the MSCI index, which is basically about 85% of the world's biggest companies, right, all combined in one index, right, you would have made 10%, still underperform inflation, right, but you've made more than actual cash. Now, what if we look at this over 15 years, right? And now you can see the big difference between if you had your money actually invested in the market versus if you had kept money in cash versus, if you just, again, how inflation has crept up over time. And this is why, I always stress the importance. It's always about how long you are, you should focus on having enough time in the market rather than trying to just timing the market and, perhaps a bit of, thinking that I can invest now and make a lot of money then, as long as you have the time for it, right? It's, again, quite a safe way to be actually invested. Now, capital gains planning, right? Now, I won't go through this too much in depth because obviously Mitch has already mentioned on this. Again, you can realize £6,000 this tax year, which is going to reduce to £3,000 in the following tax year. So what are these different strategies that you can do? Bed and breakfast, which is a very simple name for if you've made some, if you have some gains, you can actually create a gain of up to £6,000, both for you and your spouse for this tax year, and then buy them back again. Although there is a rule that you have to buy them back after 30 days, right? For it to be really effective. And you will essentially have reset your gain. So you haven't paid any capital gains tax and you have used up your exemption. So that's a bed and breakfast strategy. Spouse exemption, right? So if, for example, the majority of shares are in the hands of one spouse, what you can do is transfer some of that into the hands of the other spouse without any capital gains. And then they can then dispose of it using their own £6,000 capital gains exemption. So there we go. As a married couple, you now have £12,000 of capital gains exemption. Tax loss harvesting. So that means if you have actually made a loss on a certain investment, right, you can actually, for this tax year, sell that particular investment, right? And as long as you buy that back after 30 days, you've actually crystallized a loss. So, and you can actually register that loss against any gains in the future without an expiration date. So my £1,000 loss today, right? And if 50 years down the line, I've made £1,000 gain above any exemptions that applies at the time, I can actually offset that £1,000 from today. So again, no expiration dates. Bed and ISA is very interesting. It just means it's the same as bed and breakfast, but better. There is no more 30-day rule as long as you reinvest it into an ISA. So you get to crystallize, you get to use up your capital gains exemptions. And as long as you put them into an ISA, you don't need to wait for 30 days. So actually very smart planning. Lastly, you can actually use a deferral. You can use capital gains tax deferral by enterprise investment scheme. Right, this applies for people who have, again, have had quite a large capital gains. If they, for example, sold a property or sold a large shareholding, which could be actually from the employer, if it's like a share that you are given by the employer, right? You should explore options such as, using the CGT deferral relief via an enterprise investment scheme. So again, please seek professional advice because these are quite sort of sophisticated investments and high risk. So be careful. And speaking of that, just wanted to really mention a couple of tax efficient vehicles that you should be looking at right before the tax year, because all these allowances right do reset, and it's on a use it or lose it basis. That includes a seed enterprise investment scheme, which again applies to people who have a big, especially for people who have got a lot of capital gains arising, because that's quite helpful to use this to mitigate that. You have the enterprise investment scheme and venture capital trust, and also for people wanting to start planning for inheritance tax, using an inheritance tax service, which is essentially investing in business property relief qualifying shares, and then within 2 years they will be outside of your estate for inheritance tax purposes. Now, bearing in mind that all these above tax efficient investments are high risk investments, so again, please seek independent financial and or tax advice really before you go into these types of schemes. And really lastly, wrapping up, alongside Mitch, that intergenerational planning usually right now is the best time to actually start planning about that, because now you're thinking about tax efficiency, now you're thinking about plans for your business, right? Whether you want to potentially create a succession plan for your business, potentially passing it down to the next generation, passing it down to other people, selling your business, right? Whilst you're thinking about these things, right, it's important to have to use a 360 sort of team behind you, which includes tax perspective, financial perspective, legal perspective. How can you create the right structures? How can you protect your wealth that you've worked hard to create, right? And just put together a plan for your business, for your family, so that again you're paying the least amount of tax and you're protecting it for not just your next generation, but hopefully for across your bloodline. So we've always seen that people talk to us more right before the tax year because they're just thinking about this, whereas for the rest of the year they're thinking about how to actually manage their business and grow their businesses. So yeah, really now opening up to the floor for any questions and answers. I can see there's a couple of already. So yeah, thank you very much.
Yeah, thanks everyone. I just wanted to talk about a couple of structures that we're looking at just on this point before we open up some questions. So I'll give you a chance to do ask some questions in the chat bar. For those on social media, if you do have questions, please put them in the comment section. For those who have just joined on Instagram, we are being in the midst of hosting a live webinar, so welcome to the final part. I guess I just wanted to talk about some typical structure that we look at. That may typically involve a company. Most of our clients are fast growth entrepreneurs that have a trading business, building up reserves, and then they're looking at ways in which they can move monies to invest for their family or invest in real estate, protect their shareholding and everything else. So we would look at a potential corporate group to see if that fits for them, so that instead of extracting monies and paying income tax on the corporate dividend, they can on a sort of normal dividend, we can move monies to a corporate shareholding and that would be exempt from income tax, and then they can invest in a sensible way into other assets via the use of a limited company. Limited company can give governance for a family as well. So potentially in that top holding company, we could establish a family shareholders agreement. We can potentially put some of the shares into trust if that works. Or we could establish two companies. So you have one trading, one investment. All this type of planning would need to get rubber stamped by HMRC. So we go through a process called statutory clearance. and it need to be for commercial reasons, then HMRC would rubber stamp that and then get that all approved in terms of any capital gains and stamp duty and tax exemptions as well. But as Chenji said, you know, these 3 months, January, February, March, but certainly the benefits of looking into tax planning now would mean that you sit with your advisors, you get the advice, and then you give yourself the chance to implement the advice. Because obviously what we don't want to happen is that you leave any type of planning until March, and then that doesn't give anyone enough time to actually implement the advice or implement the work in order for you to benefit from this tax year, because the tax year ends in a few weeks' time. So anyone that wants to look at any type of planning should look at getting in touch with us or your advisors, you know, now really over the next week or so. So we're now going to just hang on for around 5 minutes. If you do have any questions, please put them in the comments. You'll also see our email addresses on screen. So if you did want to get in touch with myself on the tax side or Chenji on the financial advisory side, then our details are on the screen now. So we've got a question that's come into the chat, and it looks like it's from Chenji. So it's a question that says, how many different pensions am I allowed to have?
Great question. So actually, you are allowed an unlimited number of pensions, right? So as long as you are, again, contributing only up to £60,000 per year, plus all the carry forward allowances, you could have 100 pensions and HMRC don't actually care. Now, whether you want to have 100, you know, whether you want to manage 100 pensions, that's another issue, right? So what we're seeing right now is actually, right, if you have multiple pensions, right, there are benefits of actually consolidating them, and that, you know, one of the key drivers of that is costs. So if you imagine if you had a bit of, you know, money with everywhere, you're going to be, you know, you will have the highest cost applying across each of them, right? So if you combine them together, if it reaches a certain threshold, you usually see the platform, the pension providers, right, the cost of that, the platform charge, what we call, start to come down as the amount actually go up. And secondly, if you have, you know, if you want to actually really have a good investment strategy that's in your pensions, be focused, right? So if you're a very low risk investor, right, you know, don't invest in high risk things, which, you know, various pension pots might be. And if you are actually like a very young person, you have another 30, 40 years of, you know, of career ahead of you, right? You shouldn't be invested in low risk investments. You should actually be looking at, right, things that will actually grow for you, because you can't touch your pension for the next 30, 40 years. And you might realize that some of your pensions that you have lying around, right, they'll be invested in things that you don't actually want to be invested in. For those who have preferences in terms of, I don't want to be invested in, you know, defense companies that's fueling all the wars that's happening right now, right? You know, some pension will not invest into these type of companies, but other pensions will invest in them. So really just having a better idea of how and where you're invested, right? You would benefit by having, again, one larger pot, right? Rather than versus many smaller pots, because you get the cost efficiencies and you get a unified investment strategy in one pot. Great question.
Thanks, Chenji. So we're just answering some questions. So there's a couple more questions on pensions. So one here from Resham, who says, can you pay pensions straight into a SIP from your limited company?
Yes, you can. Right. So assuming that you are a director of the company, you're an officer of the firm, you are able to, right, make a pension contribution to from your limited company. Now, just something you have to check with your accountant or tax advisor, you know, whether, you know, if you are, again, if it's a trading business, it has to be what's called wholly and exclusively for the business. If it's an investment company, like a property investment company, as long as that pension contribution justifies it as an investment expense, then that is fine as well. Bearing in mind, you know, that pension contribution has to be dated before 5th of April, right? Even if your financial year end, you know, finishes after 5th of April, you have to actually date it before the 5th of April to actually use this year's, so 23, 24 tax years allowance. So a lot of people actually make that mistake. They kind of like, do it a bit late, thinking the financial year end is afterwards, or maybe like, I can count it for this month, but no, the actual payment has to be before the 5th of April.
Okay, brilliant. Thank you all for your questions. Another question on pensions from Shahid. Thank you very much. How can SAS accounts help in tax planning? So, Chenji, why don't you just explain what a SAS is, and then discuss any points on planning?
Yeah, absolutely. So again, great question. So a SAS, just in English, is it's a small self-administered scheme. It's a type of pension scheme, right? So pensions exist in various forms. A SAS is the most sophisticated form of pension existence, right? Whereby you basically have a lot of options to invest in, more than any other type of a pension. Now, this is both a blessing and a curse, because it's a blessing because you have the option, and it's a curse. You actually have to decide what option is best for you. Now, can it help in tax planning? Absolutely, right? Because first of all, you get the same tax benefit of money going in as any other pension, right? So income tax relief, dividend relief, everything else, right? But you just get to, again, hold things such as commercial property. You get to actually loan out money to other people, including yourself, right? And you get to actually buy things such as actual physical gold that you can keep in a vault. So it's flexible, and it can certainly help in tax planning, having the flexibility. But again, fully depends on your personal circumstances.
Yeah, we find that a lot of our business owners who are involved in property and commercial real estate may like to explore some of the benefits of a SAS. So it could give good options around that. But of course, it's very important with any type of pensions and investments that you seek independent financial advice. So thank you very much for your questions. So that's going to conclude today's webinar. We will be hosting 2 more webinars before the end of the year. In particular, the budget is coming up on the 6th of March. So let's look out for that. We will be doing a full debrief, but also make sure you're following all our accounts on social media. So our Fusion Consulting group has its account. There's lots of good resource on there, lots of good videos. Check out our website. And then, of course, you've got our personal social media, so you can continue to follow and enjoy Mitch the Taxman, posting good content on there as well. So I'm going to now say goodbye, and I wish you well. I hope to thank you for your time. Thank you for Chenji's time. I hope to be speaking to as many of you as possible to ensure that you're tax efficient come the end of this tax year. So thank you very much, and goodbye.
Thank you all.